Hey, fellow traders. Today, I want to kind of get into a topic that everyone is probably going to be interested in. It's going to be about the infamous golden strategy or silver bullet strategy, or basically just any kind of way to ensure that you make money in the market. If you've been trading for a while, you've probably searched and searched high and low, near and far for all these different strategies. And for some reason, you just can't seem to make any of them work. And that is because every single strategy that you've tried has one thing in common. If you've never traded before, we're going to get into that, and it's actually going to save you a lot of heartache and pain in the long run. So basically, the one thing in common with all of these strategies is not so much that it doesn't work. It has a lot to do with actually the fact that the way the strategy was designed does not fit the way that you actually read, interpret, and want to trade the market. So it does work as long as you're understanding and reading the market in the way that the strategy was intended to be used. So there's one way that we can really ultimately solve this problem, and it's actually pretty simple. Uh, Basically, it's going to be uh, just by simply trying to work out your own strategy. Now, the first thing we need to understand, though, is what is a strategy. And for the most part, it is just a way to control your risk in the market. But what does that really break down to? Well, basically, the only thing you're really trying to determine from a strategy in plain English is if you need to buy or sell, and if you should hold the trade or cut the trade and close it out. And it will also let you know if you should do nothing. So these are basically just the core ideas of the strategy itself. It's not going to be a way to guarantee that you win every single trade, but basically by getting the portion here of buy or sell, hold or cut out of that strategy and way to control risk is what that all breaks down into. Then this is how you're going to make money over a period of time. So you're not trying to bet the farm on every trade, because this is not going to guarantee that you're going to win, but it is going to give you a general idea of what to expect as you're looking for a trade, in the process of a trade, or looking to get out of a trade. So uh, what basically I want to try to cover in this video is how you can make your own strategy. Because once it's all said and done, when you get a job at a financial institution, or if you were looking to be a trader at a major firm, and you were looking to basically start this as a career out of high school or college, basically what would happen is you would first get an understanding of the market. And then the second step before you get behind the trading desk is you would actually have to come up with your own strategy. So in this video, I'm gonna kind of make up an example strategy along the way and kind of show you how you would approach making your own strategy. This way it fits your time frame that you want to trade, where you want to trade, when you want to trade. It'll give you a better idea of what your risk control can be, and it's basically going to help you be a much more confident and better trader just on your own. Because basically trading at the end of the day is your understanding of the market. Is it going to go up or down? How do you understand it? If you don't understand it and you're just randomly firing out trades, then of course you're gambling, and we don't want to do that with trading. So I'm going to clear this out, and let's go ahead and first get into a basic idea where a lot of traders will want to actually uh, use indicators to start out. It's a very easy interpretation of the market because you're getting simplified information that basically kind of sums up what's going on the chart. And I've kind of already drawn up a little bit of an example using one of the most common types of indicators, and that's going to be the simple moving average. And I've kind of drawn an example of what 3 might look like. You basically will have if you had a shorter period on this indicator, most indicators will have a period, and that's how many candles back or how long on the chart does it look back to try to determine its information. So if we start at the lower part of the chart here and look, we have an 8 simple moving average. SMA just stands for simple moving average. It basically takes the last 8 candles to determine what this value is here. And then for the 20, it does the same thing, but it accounts for 20 of the most recent candles. And that's how it will determine each line here and where it's getting to the next point. So if we have another basic candle down here, and fill that in a little bit, then it may continue that 8 SMA down here, the 20 will continue down, and the 200, of course, that's taken into the effect of the last 200 candles. And the longer the period, the longer it's going to actually take to see an indication in your indicator, and this is going to be true for all indicators that you use. For this video, I'm going to basically just use that simple moving average, and I've kind of got a theory. So what you're going to do is first kind of determine an indicator that you understand how that indicator works. So in this case, we're just going to use a simple moving average, and we're going to use 3 of them to kind of look at this strategy and kind of play out my theory and check my theory of what I might have about how to use this indicator to my benefit and understanding of the market. And we'll go through that process so you can apply this just by using any other indicator you want, be it a MACD or an ADX or Bollinger Bands or Keltner channels or just simple support and resistance with a engulfing candle. There are so many various combinations of things that you could figure out to try to work out a strategy. So let's first go ahead and move over to the chart, and we're going to put an indicator to apply our simple moving strategy. So for this, I'm just going to use the moving average ribbon, and I've already got that set up ahead of time. You can actually find this on TradingView just by going to the indicators, typing in moving average, and it'll be the moving average ribbon. They actually have 3, and I've set this up with an 8, a 20, and a 200, and I've also set the colors, made them a little bit thicker. Don't really need these here, so I'll take those off to make it a little bit cleaner. And then you'll see on the chart we already have that plotted out now. It's a little bit messy. We're on the 1-minute chart, but we'll kind of get into what we're doing with this and my theory. And also my trading style, I prefer a more short-term approach because I can much easily predict what's going to happen over the next 15 to 30 minutes versus what I can predict over the next 3 to 4 days. But you may find a style and time frame and these longer time periods of swing trading to be more beneficial to you. But this example will still apply to basically any time frame. So on this chart, I have the blue line is the 8, the yellow or green, I'm partially colorblind, I think it should be yellow, is the 20, and the red line is our 200. And basically for this strategy, I'm kind of just looking at the price at first, trying to kind of look over, and it's kind of best to try to look through the clean areas and just kind of take note of what it looks like, what's going on when things are really choppy and ugly, especially like right now. I mean, the candles are really noisy. Everything's put together. So in this part, if I'm kind of observing this type of strategy, if I'm seeing this drastic of volatility change and a lot of noise coming into the market, this might be an indication that I may not want to take any trades. But I'll just kind of browse over the chart, kind of look at what's going on. And basically, I have a theory that whenever price is coming to a moving average, and I am just going to either buy or sell based on where it is in that moving average. So let's go ahead and take a little bit of an example, like right in this area here. Let me get this loaded up. There it goes. Like, we're going to focus right on this area here. So with this theory, I'm kind of looking, okay, we have kind of some clean price action here. We have a little bit of a break, and we're showing that the blue and the yellow line are both moving up. So what my theory is that I could buy anytime price comes back into this level, because it's generally understood that most moving averages are dynamic support or resistance based on where they are, based on where price is in relation to the average. And it looks like it's using the 8 pretty nicely. So in this trade situation here, if I'm seeing something like that, I might go ahead and buy whenever it hits the blue line, and then keep the trailing stop on the line just below it. And then once we have this strong break and close below the lines, I would actually exit my trade there. So that would be a good clean example. And then you could also take note of certain things, like this is happening, looks like between 3 and 4 p.m. So that would take about an hour for that trade to set up and play out. So you always want to kind of take note as well when you're making notes about your strategy, about how long you can expect to hang on to the trade. What I'm looking for are trades that I can do generally within 15 to 20 minutes of hold time, maybe a little bit longer. This was a very good fit to the criteria. You got to actually give price time to move. So you can expect to hold it longer than that at some points in time. And then, like here we have other examples here. We can see how it kind of chopped up for a minute, but then price kind of broke out. Things started forming downward. So you could potentially take a sell off of any one of these candles here. And even if you were trailing on the 20, you could stop out there. But it did start chopping up and kind of do the same thing there, started to go down. So you could have actually sold there and taken another small amount there. And we're going to get into how we're going to evaluate everything in just a moment. I just want to kind of go over a few more examples. So here's another lineup of that theory at a little bit earlier time. So we have price kind of breaking down and below. It comes back up. It kind of shows that as being resistance. So you could take a sell there with the stop loss above and hold it until it starts to break back above and close out here. So you just want to find several different examples as you move back through the chart. Look at the different time frames. Here's another good example here. Not real clean on the average, but we can see it is kind of sloping upwards. So in this example here, we may lose a couple of times. You must expect losses to happen in every strategy. You're never going to find a perfect 100% win rate ever. So just kind of take notes of where potentially, like in this case here, we had a strong push up, and if we wait for here and take the entry here, we may not have gotten any gain at all, or if we never even decided to move our stop loss up, we may have lost that trade entirely. But in this example here, we could have taken the buy in this little zone here and kind of trailed up, let price move a little bit and trail below the lows, or use the moving average itself as a trailing stop guide. Generally, I'm kind of iffy about using moving averages for stops just because they get violated often, but the price keeps going. Generally, I like to look at higher lows for trailing stops, but it is something to consider, especially when you have a very strong push and it's very clean, it's staying below. Then in this instance, after a few candles, you could consider just using that average as the trailing stop. But in this case, it doesn't always work out as planned. Like here, you may not have gotten much. then here you would have stopped out and lost. Here you may not have gotten much. So you're going to have situations where this happens. So you will have to account for that. So now let's go ahead and get into the part of how we're going to evaluate how we're going to do this. So a lot of times, even if you're just getting into trading, you're going to probably have an understanding that there are several variables involved. You've got your lot sizing, you've got margin, you've got pip value, you've got risk reward ratio, you've got percent of the account. There's just so many different numbers that you have to keep up with. In this part of the process, though, we're only worried about one number. So in order to make that one number, we first must have to determine one thing. The way we're going to take this, the way we're going to evaluate everything is that we have each trade is going to represent one unit. This is a completely arbitrary unit. It is just to represent one of the same every single time. It could be a 0.01, it could be a one lot. It doesn't matter. It does not matter at all. It is just represented as one, and it will be exactly the same every time. We're going to pick this as our arbitrary unit because of what we're going to measure to see how well our strategy does. And we actually don't need a calculator much for this, but I'll show you in the end how we'll calculate everything out. So just keep that in mind. Everything is one. And the only thing that we're going to do at this point is we're going to look at our long and short tools, and we're only looking to see how many pips we get in positive and how many pips we get in negative from each side. And then at the end, we're going to add up all of the pips in positive, all of the pips in negative, and then we're going to total up how many trades we actually take. And then we're going to use a small variable to kind of account for our trading costs and get a final total of how many points that we actually gained or lost. We're not worried about applying a dollar value to any of this yet. What we're trying to look at is if we take a set trade of a set size, what can we do with that and how well can that help our account just by being a singular size. And then you can work up to actually making it a certain risk percentage. I know it's highly advised to use a 1% risk per trade, but occasionally you can get some variances in that, and then that can lead to other variances, and you could end up actually doing quite worse, especially once you involve trading costs and losing streaks and so on and so forth. You could actually end up with quite a few different variances. So we want to try to eliminate all those variances when we're trying to evaluate our strategy. Now you can actually do this with live market price. It is usually good practice, but generally you want to try to come up with a back test first to try to get at least a handful of results before you go in and enter the trade, because remember, we're looking at time periods where it could take up to an hour for that trade, and if you're doing some back testing and doing it in an efficient way, you can actually test several trades over the course of an hour instead of just one. Now, I know there's a lot of back testing softwares out there. The one I do recommend is not always exactly the most affordable option, although I do feel like it's the best. It does account for all your trading costs, your swaps, commissions, and so forth. And it has some of the best data as well as some of the best settings. It also includes the floating spread or a fixed spread. So a lot of different options there, but of course it is not exactly the most affordable, but I will include a link for that. If you use any links down below, it does help the channel and kind of encourages me to make more content. So if you do use those, I do appreciate that. So basically, we're just going to go and for backtesting, one of your cheapest methods is to just simply sign up for TradingView on the free account and just simply look for your setup. Look for the rules, look for how things play out. and kind of visualize and work out how you might trade it based in the rules and criteria based in your theory. So just to save a little bit of time in the video, we'll put up a few examples of using the tool. So like based on our rules, we're showing a little bit of support there off of that level. So we may want to look at the lows, and we would actually want to close out our position once it starts to show a breakdown of that level. We could even go a worst case scenario of, say, we waited to there, and then we're going to do the similar thing again in this example here, and see, cover the low, maybe a little bit below it. Let's say we didn't get it quite on the line there because we weren't sure, and then we hold and see if it breaks the highs, and then eventually we go to this point here where it starts to break down. And with this tool, you'll need to actually set that to where you stop it at for the next part of what we're looking at, because we're going to use the number that it's giving us. And make sure you're trying to look for both sides, both situations. So like in here, we went from long, and now we could immediately actually go short in this example. So we're starting to show some rejection there. We could get in here or even here. We may want to use our 20 in that instance and see what happens. And it looks like we're probably not going to get anything on that trade at all there. We got, yeah, probably not anything at all. And then things went sideways, so we wouldn't enter, but we might take something here where we would do this example, and now we're starting to break back below. So once you've got a few of these put together, then what you're going to do, you've actually got to try to find several more situations, but I just want to show this as example. Let me go ahead and find something here where they're not all winners, because clearly they're not going to be. So we might say we lost some on this one because we tried to go short there. You can probably even put up this example here where we tried this, not going long, going short. So we may have bought there. And make sure you're finding both sides of the equation. You don't want to leave out the losers just because you're only looking for the winners. I mean, clearly we do want to win, but that's going to give you a false sense of security. And it's also going to give you false results. It's much better to actually activate the replay, which would be your second best option, your second cheapest option. In order to activate replay on anything below the daily chart or the daily time frame, you will need at least the first level of their paid subscription. I think it's called the Essentials, I believe it is. It's the one that is $14.99 a month. I forget what it is for yearly. I just kind of pay for it by the month. But the best thing to do is to actually activate the replay. So, and one way you can actually do this without cheating yourself is to completely shrink the scale. Then scroll back. And then you will want to clip from that point and move forward. Okay, so it does look like we've clipped straight into a situation. Now this does kind of fit our rules. We have a great little setup here, and in this instance, if you do use the replay tool, just click the 1000. That will be sufficient, but I would still advise to go ahead and still use this tool, because what we're going to do at the end is we're going to take the results of all of these plus and minus, we're going to get a total pip, and if that pip is positive, then we have a good strategy. If that count is negative, or that number ends up negative, then we very easily know that it's already a bad strategy. If it does come out positive, then we want to take the total number of trades that we've taken, and we want to actually multiply that times either a 0.5 or a 0.7 or a 1, and that would be relative to your commission. So if you have an account that offers, say for example, a $6 commission, and we had, for example, taken, let's say we had a $6 commission, and we took 15 trades in our strategy, we would then take that and multiply it by 0.6. And the reason we would do that is because this will take away 0.6 out of the total pip count that we take out. Now, if you want to do it in points, you would still need to multiply this by 0.6 to get your value. Yeah, just multiply it by whatever your dollar amount. So if you have a $6 commission, just use 0.6. If you have a $10 commission, for example, on ANDA, you would multiply this by 1. And basically, whatever number you get from this equation, so in this example, it would equal 15. So that means that if we had 15 total positions, we would then minus 15 points out of that position. And let's say, for example, at our total after 15 trades, we made a positive gain of 150 pips. We would then take away 15 pips from that 150 pip gain, and that would leave us with a finished number of 135 pips. So that would be actually a profitable strategy if you were to use just the same size, because it made more in pips than it lost in pips. I know it can get rather confusing to use dollars, so I kind of propose to kind of figure your strategy in this way, because oftentimes, like I kind of explained earlier in the video, once you start adding more variables to the equation, the more you will actually end up with a variance in your expected output. So by using a fixed rate, we can kind of expect, okay, after several test runs, we'll kind of make the same little equity gain and so on and so forth. But once you start adding variable risk sizes, like if we had, like say for example, we had a short stop on this trade, but we had a larger stop on the other trade. So in the short stop, we're going to risk the same amount percent-wise as we would for the large stop, but we end up working our risk out a different way, and we also have a different effect on our psychology, because now we're worried about our value amount. It's going to change different to what we're expected to, and then ultimately you're going to actually end up with maybe one test run going like that, maybe one test run going like that, then you may have another test run that goes like this. So you end up getting different outcomes, whereas by using it with fewer variables, fewer things that can change on each trade, you end up getting multiple different curves that come out close to the same, versus this variance that could ultimately end up with more going way down here in the long run, because that's going to actually have a lot to do with your psychology then at that point, because you're going to be seeing so many different things versus just seeing one thing, and that's going to be maybe a larger loss on this trade but a smaller loss on the next trade. And then it also allows you to actually let your winners run, because based on your indication and what your understanding of the market, you know it's going to keep going based on your interpretation. You're not always constantly guessing, trying to say, oh, is this the top? Is this the top? Is that the top? Oh, it was the top. Oh, is it going to go back up? No. Are we going down? What's it going to do? What's it going to do? Well, let's find out. It's going to do nothing and then go down. So, instead of constantly guessing, we can clearly see here, okay, we probably should have went short here. We could have went short here. And we would actually end up with a small amount. Here, based on our rules, we would be using short, small stop losses. And if we had caught this trade here to go short, let's say we entered here or even just entered there, based on our rules, we're going to enter right on the line. And we're going to cover the last little area. We might even cover the last high or the 20 moving average. And I'll clean up the mess here a little bit. And now, based on those rules, we could just keep moving our stop down. We'll let the blue line represent the stop. And we're starting to get a breakout now. So we could just continue to leave that out. Or even at this point, look at how much reward we've already brought back. But even if you're not looking at the reward, that would be 7 pips in gain, 1 pip in risk. So even now, we are up 7-1 in our point ratio of gain. So if we were using that arbitrary 1 unit, okay, yeah, we lost 1.4 here, but now we're up 7. So now in this current example, we're up 5.6. If we were to just close it right there, just because, for the sake of example, we now have 5.6 as our total result, because we had a 1.4 negative loss, and now we're up 7, so that'll make the result of the 5.6. And then if we're using a $6 commission, that would make it 5.0. So ultimately, just between those two, we have made 5 points. And then see, we could take our next trade, wait for the next entry, risk a small amount, or we could just continue to let this trade run and see if it's going to play out more in our favor. We pull that down. We're starting to say, okay, we might take an entry here. So we'll just kind of put that up a little bit above that mark. And it looks like we might have wanted to close it there, but it did hit the stop ultimately there. So we are ultimately looking at making 6.4. So even still, taking that away, 5 minus your commission of even just $6, that's 4.2. That's still a gain. But you would keep doing this throughout. And as long as you have more points positive than negative, when you add all this together and subtract your trading costs by figuring it out by points that way, then you will ultimately know quite easily without complex math if you've got a viable strategy or not. And then it's just a matter of maintaining your risk control and using size instead of stop distance to figure your risk. And you'll keep a little bit more control over your account as well, because there will be less variables to create that variable curve in your equity, and you'll know much more about what to expect. But I'm going to go ahead and wrap things up here. If you got any benefit or value out of it, just, leave a subscribe and thumbs up, comment if you have any questions. But basically, all you're trying to do is find a good way to understand the market, understand whether you need to buy, sell, hold, or do nothing, or cut out your current trade. And from there, just a simple test. And once you have done this through several trades, kind of get an idea of what you're going to expect, then you could enter with a small demo account. I'd recommend kind of using a demo account valued around what you're going to begin trading with. And I would also advise kind of starting with smaller amounts at first. If you do go straight into real capital, you don't want to put your life savings in the market and then ultimately end up losing that, because there is always a chance that even with the best strategies, In even professional traders go on losing streaks, so you always want to make sure that you're using a reasonable amount of risk. What I kind of advise is if you're nervous, excited, your heart rate's going up while the trade is on, you're probably risking too much. Trade a little bit less, and you will it will work out much better for you in the long run. But that's a wrap for this one. I'll catch you on the next one.